The paper market says $81. The physical market says $93. That $12 gap is the biggest divergence since the 2020 negative oil event. This week's inventory reports could trigger a violent move. Watch my full analysis for the exact levels to watch on Brent and WTI. Subscribe now. This is the moment where paper meets reality. Brent Crude Oil is priced at 88.60 on the screen, WTI at 81.47, but the physical spot market is screaming something entirely different. Physical Brent is trading at 93.26, and I have not seen a divergence this extreme since the chaos of April 2020. The market is trying to tell us two conflicting stories, and over the next 24 hours and 5 trading days, that tension is going to resolve itself in a violent, directional move. The geopolitical heartbeat of this market is pounding harder than it has in years, and it is not going to slow down. This is your Alpha Market Meridian Weekly Outlook, and today we are going to cut through the noise. We are going to talk about the Strait of Hormuz blockade that has now entered its 6th month, a blockade that has slashed oil flows from 21.6 million barrels per day down to just 4.9 million. We are going to talk about the U.S. Navy enforcing a maritime embargo on Iranian ports, and why that matters for your trading account. And we are going to discuss a fundamental reality that many traders are ignoring. The divergence between the U.S. domestic supply situation and the international physical shortage is creating a trap for the unwary. I have been in this game long enough to know that when the paper market disconnects from the physical market, the smart money does not sit on the sidelines. They pounce. The verdict for this week is clear in my mind. The path of least resistance remains to the upside, but it comes with a significant caveat. We are trading in a geopolitical premium, and that premium is vulnerable to a sudden repricing if headline risk shifts. My official bias is bullish for the week, but my invalidation level is key. If Brent crude closes a daily candle below 86.50, or WTI closes below 78.20, I believe the structural trade is broken and you need to reassess your exposure. But until that happens, the bull case is strong. The IEA confirmed that global observed inventories plunged by 69 million barrels in July alone. That is a staggering number, and it tells me that the physical supply deficit is real, not just a headline. The Asian refiners are in a state of panic buying, locking in spot cargoes up to 90 days in advance. I am looking at the technical picture to confirm this fundamental reality, and right now, it is doing exactly that. Before we look at the charts, we need to talk about the news cycle because that is the primary driver of oil right now. The ongoing U.S. Iran war is the elephant in the room. The Strait of Hormuz is effectively a choke point, and the U.S. Navy's maritime blockade is successfully strangling Iranian exports. But more importantly, the fear of escalation is forcing physical buyers to pay an extreme premium for cargoes that are not even at risk. Now, here is the part that stands out to me. The EIA reported the second largest weekly domestic crude stock build in U.S. history, a 17.4 million barrel increase. On the surface, that looks bearish. But I want to explain why this is a localized phenomenon. That build is concentrated on the U.S. Gulf Coast because export windows are collapsing. Those barrels cannot easily substitute for the sour crude grades that Asian refineries need. So while the U.S. inventory data looks like a glut, the international physical market is experiencing a famine. The calendar this week is loaded with potential catalysts. On Tuesday, we get the API inventory estimates. That is the first clue. But the real volatility will hit on Wednesday with the EIA report. The market is going to react violently to any surprise there, especially if the 17.4 million barrel build reverses. And then on Thursday, the U.S. Treasury is updating its secondary sanctions against third-party buyers of embargoed crude. If they target Indian or Chinese entities, we could see a direct supply shock that sends prices surging into the resistance levels I am tracking. Now, let us align the fundamentals with the price action. On the weekly chart, both Brent and WTI are in a strong bullish trend. They have climbed 3.5% to 4.2% over the past 30 days. Driven by those severe physical bottlenecks. The structure is intact. The moving average picture is exceptionally clear. Prices are trading firmly above their 20, 50, and 200-day moving averages. That is a textbook signal of a long-term structural uptrend. I am watching the relative strength index on the daily time frame, which sits at around 62. That is bullish momentum, and it tells me we have room to run before hitting technical overbought levels. The MACD is also bullish, with the histogram bars expanding positively into the green zone. That is confirmation that the buying pressure is not fading. But this is where my personal experience kicks in. I have seen this exact divergence 3 times in my career. Twice it led to a violent reversal to the upside, and once it didn't. The tell is the ATR, the average true range, which is exceptionally high right now. We are in an environment of intense intraday swings, spurred on by a $40 swing range over the last 30 days. That volatility is your friend if you respect it, and it is your enemy if you ignore it. On the 4-hour and 1-hour charts, we are seeing consolidation. The market is settling into a tight range as trading sessions reopen for the week. This consolidation is likely building energy for the next breakout. The CCI at 115 is hovering near overbought boundaries, which reflects the prompt market buying pressure, but it is not a sell signal yet. Based on this analysis, I have structured my trading plan for the next few days. Let us look at the scalping opportunities first, and then the larger swing trade scalp one. The upside breakout. The first scalp is based on a breakout of the initial balance, which I define as the high and low of the first hour of the London or New York session. For Brent, I am looking for a 5-minute candle to close firmly above the pivot point of 88.20. My target for this scalp is the first resistance level at 89.50. I will place my stop loss exactly 30 cents below the entry candle. The risk-to-reward ratio on this trade should be around 1 to 3, which makes it a high probability play. Scalp 2. The downside reversal. The second scalp is a short setup. If Brent breaks below 87.60 and closes below that on a 5-minute candle, I will enter a short scalp targeting 86.50. The stop loss on this trade is 30 cents above the entry. For WTI, the corresponding levels are 80.40 for the short trigger and 78.20 for the target. However, and this is crucial, I am only taking these scalps if the 15-minute RSI is between 40 and 60 at the time of the breakout. That ensures we have room for momentum. We are not chasing a trade that is already exhausted. Swing trade. The 5-day plan. This is the trade I am most focused on. The swing trade is designed to capture the expected move over the next 5 days. Given the geopolitical risk and the physical shortage, I am leaning long. The entry zone for accumulation is if prices pull back to the support levels. For Brent, I am looking at a pullback to 87.60, possibly even dipping to 88.00. For WTI, I want to see a pullback to the 80.40 to 81.00 zone. I am using a scale and approach here, adding to my position as the price confirms support at those levels. My stop loss is placed below the secondary support levels, which I consider the structural invalidation points. For Brent, that is 86.40. For WTI, it is 78.10. If we break below those levels on a daily close, I am out of the trade completely. The profit targets are ambitious but based on the resistance levels. For Brent, I am targeting a 2 at 90.30 and a 3 at 91.80. For WTI, R2 is at 83.00 and a 3 is at 84.80. What I always remind myself, and I want you to remember this, is that holding positions across multiple days incurs overnight swap or rollover fees. In this high volatility environment, brokers are expanding spreads significantly. Factor those fees into your risk calculator. Do not let a winning trade become a loser because you ignored the cost of carry. Let us talk about the reality of this environment. Oil is not for the faint of heart right now. The implied volatility is punishing. What stands out to me is that the massive U.S. inventory build shows that supply is trapped locally inside the U.S., but that does not mean the world is safe. The fundamental reality is that physical oil is scarce in the international market. The IEA recently cut its 2026 demand growth forecast by 1.6 million barrels per day. That is demand destruction. High pump prices are crushing consumer demand, and that is the bear case. If the Middle Eastern shipping lanes normalize, we could see a sharp price drop, back towards $69. But that is an if, not a when. I always tell my traders, manage your risk before you manage your profit. Set your stops, size your positions appropriately, and never let a trade become a gamble. To sum up the week ahead, keep your eyes on 88.60 for Brent and 81.47 for WTI. These are your pivot levels. The geopolitical volatility is going to remain intense, and I expect the API and EIA reports to inject further volatility into the market. I will be releasing a Friday update to cover the closing price action and a Sunday preview for the week ahead. If you found this analysis helpful, make sure to check out my previous weekly recap for a deeper look at the macro trends. Hit that subscribe button and turn on notifications so you do not miss a single update.